As millions of baby boomers are approaching retirement, many are looking for tax-free income planning as part of their overall retirement planning. Here to discuss how to develop tax-free income is my guest, Jeremy Dopp with Security First Financial in Mesa, Arizona. Jeremy, welcome back.
Good to be here, Scott. Thanks for having me.
So in the context of income planning, how does someone create a tax-free plan?
Well, one way that people have done that in the past is by taking a traditional IRA and converting it to a Roth IRA. This isn't necessarily a tax-free way of doing it, because you do have to pay the taxes when you convert that IRA to a Roth IRA. But if you have enough time to grow your assets, it can be a great way to create tax-free income.
Can you talk about the role that insurance would have with income planning?
Well, in the past, people have used life insurance traditionally for wealth transfer and death benefit, but some of the products today with life insurance are much different than the way they're created in the past, and they can be used to create cash-free accumulation as well as tax-free income.
Now, how would you use life insurance for income planning?
Well, one way that we do that is we design the policy to focus more on cash accumulation, and we pile a lot of cash in the policy. Rather than focusing on death benefit, we're piling cash so that we can accumulate in a tax-free environment, as well as turn that income into a tax-free vehicle for you at retirement.
So I guess it's fair to say in just about every case, tax-free is better than taxable, right?
Well, I definitely, Scott, think that goes without saying. If you take, for example, $1 million in a taxable asset versus $1 million in a tax-free asset, that can be as much as $400,000 in taxes that could be owed on that taxable asset.
So Jeremy, what can a person do if they would like to start putting money into a life insurance vehicle?
Well, there's a lot of different ways in putting money into the policy. I have clients that in their 20s all the way up into their 50s that are putting in monthly amounts into the policy so that they can get some tax-free accumulation and turn that into tax-free income. I also have clients that are putting large lump sums into the policy. Either way, you put money into these contracts, they're a great tax-free vehicle to create income in retirement.
Well, Jeremy, where could people start if they'd like more information?
Well, I think the best place to start is to get in touch with an advisor, first of all, and schedule an appointment to take a look at how it works for you personally and in your financial world. The way you could reach us is by going to our website at www.securityfirst-financial.com. You can also reach us by phone at 480-330-6439.
My guest has been Jeremy Dopp with Security First Financial in Mesa, Arizona. I'm Scott Drake. This is Retirement News Today. Thanks for watching.
Why timing is everything, especially concerning your retirement. Often, the best way to learn is from someone else's experience. Let's see what we can learn from Joe's choice to delay his retirement and ride the ups and downs of the stock market before trading volatility for less risky options. Like Joe, you've probably worked hard your whole life and believe you've earned a worry-free retirement. That's how Joe felt after raising a family and becoming a grandfather. In 1999, Joe was going to turn 65. The markets had seen nice gains over the last few years, so Joe's plan was to work one more year and earn a little more before he officially retired. At the time, things were looking good. In March of 2000, the S&P 500 hit an all-time high of 1527. But then the S&P began to decline. Over the next 2 years, the S&P lost 45% of its value, hitting a low of 815 in July 2002. Now age 67, Joe was no longer in a position to retire. He would need to make up his losses. Unfortunately, he now needed to earn 87% just to get back to his original balance. It took 5 years, during which Joe had to work, but the markets rebounded and in July 2007 hit a new high of 1526. Joe was 72 and feeling better about his chances of retiring soon. Yet, one more time, the market stopped cooperating and declined 47% in the next 2 years, hitting a low point of 683 in January 2009. Still working at 72, Joe would have to wait even longer to recover his latest losses. Today, Joe is 78 and feeling that old familiar hopefulness as the S&P reaches an all-time high. But even with all the excitement, all the highs and lows, Joe's portfolio between January 2000 and July 2013 has grown by just 13%. And Joe has had to work the whole time while he waited for the market to recover. Bringing this issue closer to home, can you afford a loss of principal? Do you have time to wait for a recovery? You have choices right now. There are retirement products that can protect you from market losses and still provide a fair rate of return. Your retirement future is in your hands, and timing is still everything.
With the untimely death of actor James Gandolfini recently, many people are reminded of the importance of, well, taking better care of yourself and having a good estate plan. My guest is Jeremy Dopp with Security First Financial in Mesa, Arizona. Jeremy, welcome back.
My pleasure. Good to be here.
So it's been reported that Gandolfini's estate was somewhere in the neighborhood of $70 million. What kind of estate tax bill should his heirs be planning for?
Well, in an article that I was reading, it said that about 80% of his estate would be taxable, and of that estate tax, about a rate of about 55%. And the thing that could have helped is if he would have had a good estate plan in force, he could have avoided millions of dollars in estate tax for his heirs.
So it's been said that estate planning is sort of intimidating for many consumers. Is there any reason for people to be afraid of estate planning?
Well, I actually believe that the opposite is true. I think that people should be afraid that they're not doing estate planning and some of the consequences of not doing so. I think a big misconception out there as well is that estate planning is for the rich only and that it can be very expensive. And I think that estate planning can benefit everyone out there. And if they look around, it can be very, very affordable.
So why is estate planning so important?
Well, one thing to think about is probate. A lot of people may or may not have heard of probate, but probate is when you haven't taken care of your estate plan, and the probate process can be very expensive if your assets have to go through probate. It can be very expensive for your heirs, and hiring attorneys can be very expensive as well. Another thing to think about, I think a lot of younger people aren't so concerned about probate, but one thing to think about is also guardianship for children. Healthcare directives are very important, as well as powers of attorney and all those. There's a lot of legal documents that are taken care of in the estate planning process that are very important.
Where is the first place someone should go if they would like to get an estate plan done?
Well, I think the first place to start is with an advisor. Advisor understands all of your assets, and he can sit down and go through your assets and help you understand how beneficiaries should be set up and how each one of these assets are affected if you haven't set up an estate plan. After they've gone through some of those resources and your assets, they can sit down with an attorney and an accountant and bring those professionals in to help you get your estate plan done properly.
Now, Jeremy, is there something a person can do immediately that could have a positive effect on an estate?
Well, one thing a person can do is to sit down with an advisor and go through each one of their assets and understand what beneficiaries are set up for each one of those assets. And by understanding that, they'll know the tax consequences. They can also understand whether the beneficiary is sufficient or whether they should, make sure and set up a trust to make sure that those assets don't go through the probate process.
Well, finally, Jeremy, it was also recently reported that singer Whitney Houston had not updated her will in 20 years. So how often should someone go back and review the estate plan?
Well, definitely 20 years is way too long to wait. I like to encourage my clients to do it at least every 3 to 5 years, if not sooner, depending on how frequently they change in asset purchases, things like that. So I would encourage people every 3 to 5 years should be sufficient in reviewing those assets and making sure that your estate plan is set up properly.
Jeremy, that was great information. If someone watching had questions, how would they get in touch with you?
You can reach us at www.securityfirst-financial.com or by phone at 480-330-6439. Jeremy, thanks again.
Good to be here. Thank you.
My guest has been Jeremy Dopp with Security First Financial in Mesa, Arizona. This is Retirement News Today.